Good morning. Welcome to Saxo's weekly market outlook call. We'll just give it a few more seconds before we kick off. There's a lot of ground to cover today, but let's give it a few seconds for some more people to join in. Hi, and once again, welcome to Saxo's weekly market outlook call. I'm Charu Chanana. I'm a market strategist with Saxo Singapore, and I'm joined today by my colleagues Redmond Wong from Saxo's Hong Kong office and Jessica Amir from our office in Sydney. So 5 weeks to go for the year end, and we have a lot of key stuff to watch this week, which we will cover on this call today. So let's get started. I think the focus entirely this Monday morning is on China's zero COVID policy again, and the latest round of protests that are signaling massive discontent in the public, and also I think for me, it is actually a positive signal. It's finally an overcoming of the fear, which is really needed to get to that endemic phase. But of course, it's a journey, and it's going to take some time. There will be some short-term pain, but of course, let's hear from our China expert Redmond on what this could mean for the markets in the near term and where we could eventually end with this.
Hi, morning, everyone. I think that probably will create some kind of uncertainty because it's the market is really keeping up and down towards this China reopening hope. And that has, after China has introduced some fine-tuning policy and not to abandon the COVID zero, but some fine-tuning, and the market become very optimistic. And as the cases should to now near 40,000 and getting to new high every day, and the market become a little bit nervous. And then last week, starting in Xinjiang, after that deadly fire, killing 10 people, and that trigger anger and protest. People took it to the street, and then the tens of hundreds of people protest there. And then and then I think it's the concern really over the weekend is that how protests and spread to other large city, mega city, including we have been seeing footage and photos on the social media, and people are protesting now in Beijing, Shanghai, Wuhan, Nanjing. This is a much more important city, of course, is than just is what's happening in Xinjiang, and that create a lot of concern, and so that probably will be seeing some weaknesses in Chinese equities, and because on that, and because of the market investor basically expecting the immediate reaction from the government will be just becoming even more stringent rather than relaxing. So and also according to some of the video, actually the protest actually has gone as far as to not just against the COVID, but that's against the Communist Party, and also chanting slogans that has not seen in China for quite some time, and that create uncertainty, and the market doesn't like uncertainties.
Yeah, absolutely. So we have a risk of to start off the Monday morning this new week here in Asia. US equity futures are obviously pointing to a gap lower. Dollar is getting a safe haven bid as well. So let's see where we end up when we do get the European and the US markets open. I think potentially this will be key for those markets as well. But from a more macro perspective, what's really happening is that last week, I think we didn't get enough pushback from the Fed officials over those easing expectations that started to build up after the softer CPI release for October. We did have the FOMC minutes out last week and a few Fed speakers as well before Thanksgiving holiday kicked in. But overall, the message has really remained the same, that there will be a downshift in the rate hike trajectory, and terminal rates will need to be somewhat higher than what was projected in the September's dot plot. So in equities, of course, we are over 10% up from the bottom. And we keep getting this question a lot. Have we reached a bottom yet? So I would say the markets are taking this Fed downshift story on a very positive note, but not being mindful of the fact that we have a recession coming, or at least an economic slowdown there. Several U.S. Economic indicators are starting to point out weakness. Very broad weakness. It started with the housing data initially. Now, last week we had a flash S&P PMIs, again, broad-based weakness across manufacturing and services as well. The US leading indicator, which is actually almost a perfect indicator of recession, has also been in negative territory. And although we can still argue, that the labor market is still strong and consumer and corporate balance sheets are also holding up well, I think there is enough reason to believe that consumers are starting to pull back, and we will see some form of an economic slowdown in 2023. So this rally in the equity markets is a little bit counterintuitive. Also financial conditions. This is an index that the Fed is watching very closely. They are the easiest since May. So all the tightening that we've seen since May has actually been erased. So, of course, like I said, will we get a Santa rally this year? That is also something that we often get asked. Maybe Jess can touch upon the technicals later on. But, even if we do get one, we at Saxo still believe that we have lower lows coming up into the next year ahead, because there are margin pressure concerns, labor market will likely deteriorate, and we could possibly also see liquidity pressures. These are some of the concerns that are not being priced in by the equity markets yet. So if you are a long-term investor, you can possibly still start to accumulate. Warren Buffett is doing that with his investment in Taiwan Semiconductors. But if you are looking for some, tactical gains, possibly also obviously look at holiday stocks like retailers, e-commerce, and possibly some mall REITs as well. But I'll stop here. Jess, maybe you want to talk about, what's happening in the equity markets from a technical standpoint.
Yeah, you mentioned the Christmas Santa rally. So the market has already started to price that in. So it would be remiss if we didn't point out some of the best performers last week were in retail. So we spoke about in the 5 stocks to watch, keeping an eye on Ross Stores, and Ross Stores was one of the best performers last week after they upgraded their outlook. We saw Best Buy also outperforming up 12%. You have to remember that these are stocks that aren't exposed to China. While just staying on the retail aspect, China's JD.com is down 12%. So anything not exposed to China, I guess the market or some investors are buying into, because we've got our first lockdown, or our first Christmas with no global lockdowns, excluding China. So we think, or some investors, I guess, are buying options to support upside in equities in the retail space, while those exposed to China and have a lot of their tech in China. Apple, 90% of their iPhones are produced in China. They are vulnerable of pullback. So we're seeing some investors use options to protect against downside. That takes me to Apple. Look at their technical indicators, or if we pause and reflect on their technical indicators, they're actually suggesting that Apple could be due for a haircut. And the reason for this is because not only do we have headwinds in the way of consumer. So we heard about the lag effect before. So as Charu just pointed out, interest rates can typically take a while to essentially affect consumers' back pocket, and also be felt on the economy as well. And so we're thinking that there could potentially be the pullback in stocks that are exposed to interest rates as well, and Apple is indeed one of those. So demand could potentially suffer here, while on the inverse side, we do have production being questioned. And then if you do reflect on the technical indicators from the week and month charts, Apple, one of the most powerful stocks in the US and most held by the average investor, looks like it could be vulnerable of a pullback here. On the day chart, that is, I guess, probably what is most concerning. The day chart, if you look at the RSI, the relative strength index, and the MACD, some technical indicators that we look at, they are suggesting that Apple is due for potentially due for a haircut. So that's something to keep in mind. If we do just also reflect on the NASDAQ 100 and the S&P 500, the technicals are is suggesting that both are, I guess, still in a rally supported higher over the coming weeks. However, we are keeping an eye out on the day movements. Any dampener in economic news that comes out this week could reverse the uptrend. But our thinking is that the Christmas rally could potentially be supported for the rest of the year. However, that being said, keep an eye out for those hiccups. Back to you, Charu.
Yeah, certainly. I mean, short-term rally, of course. I mean, I think it is it is still possible. But like I said, I mean, we still think we are in a bear market, and we could see lower lows once we start to get those demand concerns really being priced in by the equities. But also another key question that we often get is on yield curve inversion. And, Redmond has just written a note also on how bonds are starting to look very attractive at this point. Probably it's a good time to, reflect, look at your long-term portfolios as well. And let's have Redmond, I think, talk a little bit about that, which could be really useful in constructing and modifying your portfolio as we get into this new year.
Yeah, thank you, Charu. I think now I think we talk about Charu also and I talk about the 60-40 portfolio, and it didn't work in the past. It's mainly because of the focus was in inflation, but now the focus probably will be more balanced, and the Fed will be recognize that the incoming sharp slowdown or even a recession. And having said that, they are not prepared to cut rate. I think they will keep rates high, and they have moved to a more risk management approach. Is if you can actually, they can be told from the November minutes. So the tune's basically talking more about now. Yes, I mean inflation is still elevated, and it still lead to high rate, but how far, how much, and that's something have to look at the incoming data. So more data dependent. And on the yield curve, yes, I think that the Fed are more interested looking at the 3 months versus 10-year yield curve, even though of course the media like to talk about the 2-year, 10-year. But recently the 3 month versus 10-year yield curve have gone down to as inverted as 64 basis point, minus 64 basis point, and I mean, the last 3 times when it got to this level, within 12 months, we have a recession in the US. So the Fed is watching that closely. And another thing I want to mention, excuse me, from the November minutes, you can see even all the governors and presidents who are the members of the FOMC did not mention recession at all. But in the report presented by the staff economist to the meeting, those economists, they have hundreds of economists, they prepare those report and for the FOMC member to consider and review. And in that report, and they said the staff economists at the Fed actually say the chance for a recession in the US is as much as the base case, more or less as the base case. So the base case is slow down, no recession, but the staff actually sounding alarm warning about the risk. But having said that, I mean that the Fed is prepared. Actually, they won't say it. But they are prepared to accept a recession. They will not cut rate to help to avoid the recession. But they will probably be slowing the pace of cutting rates. So that will be helping the bond market stabilized, not so much on the very near term. Those is those within 2 years, those with more affected by the interest rate hike path, and anything beyond from the 2 year and 3 to 7 year actually may be a better, it's a better place to be in, because it's when the economy is slowing, and eventually they move to a pause and down the road, but not immediately. And usually, and also when the economy moving into a recession, that is usually that part of the curve will perform. But at the moment, that over the last 1 week, the long end, i.e. the 10-year to 30-year, were the best performer, mainly because traders expecting to trading be a month before the recession. Usually the long end will be better, and because this is the market focusing on the on the slowdown. So what does that mean for us? And for trader, I think they probably will still be trading the long end, but for investor preparing for 2023 to pick up some carry and to balance the portfolio to reduce risk, and that means it's the 3 to 7 year for next year first half would be better place to be in. And we are not recommending to jump in right now at this yield level, because there's a lot, as Trevor mentioned, there will be a PCE, employment report, and then after that we will have CPI as well. So there is so many data coming in. There will be volatility, and investor should prepare for any bounce in yield, and there will be any rises in yield will be opportunity to gradually accumulate for next year, but not to jump in right away here at this current level, because we think that yield may still bounce back up a bit to give us a better opportunity to enter into the market.
We will discuss a lot more on that as well tomorrow in our webinar. If I can just jump in, Redmond. I mean, we have a webinar scheduled tomorrow. Do register for that. We will discuss a lot more on China's reopening story, as well as on this bond opportunities that Redmond has just discussed now.
Just want to have 1 minute on China. Just add two more things. We talk about the protest. That is, of course, the number one concern today. And then is that I just want to mention is that over the weekend we have the U.S. I mean, it's on Friday. You have the U.S. ban Huawei and ZTE and several more Chinese tech companies from selling and exporting to the US. So that's another bad news. And of course, is all these things is make the rate cut, the reserve requirement ratio cut by the PBOC on Friday evening, and that one was become more or less a non-event, because that is not, the impact will be quite minimal, even though they cut the reserve requirement ratio to give bank some more room to lend. But given the very weak demand for loan, that is not going to help that much. And that's all from me. I'll pass it back to you, Charu. And
Thank you, Redmond. So in terms of what to watch this week, it's an important week ahead. Like Redmond said, we have PCE inflation, which is the gauge of inflation that the Fed monitors. We have ISM manufacturing data due, and after the weakness in the flash S&P PMIs, I think again this will be key to watch. And then to end the week, we do have the jobs data as well in the US, which will be key for the dollar. Again, the risk is more on the dovish side. Higher unemployment number of falling wages could bring Fed expectations lower and could cause further dollar weakness as well. The other key thing would be two Fed speakers. So Bullard, who is one of the most hawkish on the Fed board, speaks tonight in the US hours. And then, of course, we have the Fed chairman, Powell, speaking as well on Wednesday. And, I think, given what I said earlier about the easing financial conditions, potentially these two speakers are the only two possible, who could give us maximum pushback on those, financial conditions easing. So if we do get a little bit pushback on that, it could mean some big moves lower in the equity markets as well. So keep a watch on our Fed Speak monitor on the platform. We are updating it regularly, and Powell speaks on Wednesday night here in Asia. So keep that in your calendars as well. But let's wrap it up with commodities. Again, some big moves there because of China and, Russian oil price cap in discussion. Jessica, do you want to touch upon that?
Yeah, thanks, Charu. So also keep in mind, it would be remiss to point out that a higher dollar also supports commodities as well. But that being said, I think arguably the most important contributing factor to inflation would have to be the oil price. Depending on where you live, the oil price is probably one of the biggest components of inflation. So inflation is, I guess, why we're thinking it could potentially come down before picking back up again, is because the oil price is back to where it was in January. So the oil price lost almost 5% last week. If you look at the WTI, the West Texas Intermediary oil price. And the reason for this is that forward demand is potentially likely to fall at a time when we've got production ramping up. So BP has announced at the weekend that they're restarting one refinery. We've also got Iraq planning to increase oil production as well. So all in all, I guess we've got potentially forward-looking demand likely to, I guess, take a haircut, and we've got more production coming onto the market. So I guess this is good for consumers. It's good for inflation for now, and all in all, this this potentially gives impetus to support the equity rally. But we are just a little bit cautious, and we do think that the oil price could potentially pick up, given which would be a very chilly one indeed. However, based off if you pivot back to the other commodities, copper, iron ore, lithium, they could be potentially vulnerable for a haircut given what is happening in China. That being said, the iron ore price today has opened lower. So it is worthwhile keeping in mind, though, when we speak about iron ore, shipments out of Australia or from the largest producers in the world of iron ore are actually down 6%. So shipments obviously to China, so they're down 6% compared to where they were a year ago. And this is an estimate for the final quarter of the year. So this is something to be mindful of. If the situation worsens in China, we're thinking that iron ore production could continue to fall, and that obviously means that the forward-looking demand curve might continue to slow, and that also would support a potential haircut in some of these key commodities. So we're thinking just vulnerable pullbacks of commodities here. Obviously, the big bull in the China room, I guess, is a rising US dollar as well. So not only do you have China concerns, but also the PCE data that could rock the US dollar higher, and that could support commodities. We'll see commodities taking a haircut. But I'll just leave it there unless we have anything else to say. Anything burning? Any desires?
I think we can wrap it up here.
Yeah. All right. Well, tune into our webinar tomorrow on behalf of Charu Chanana, Redmond, Wong, and myself, and all in all the team. Please reach out to your GST, to your RM for support, feedback, questions, or comments. We look forward to chatting with you tomorrow for our China potential reopening, potential closing down. What does it mean? Where to from here? Redmond and Charu and myself will have all of your answers, hopefully, and we look forward to your questions as well tomorrow. But take care, have a wonderful week, and we'll see you tomorrow.
Stay safe out there. Okay, have a good week. Bye-bye.
Bye.